Your screen's flashing red right now. Volatility just spiked, and it feels like the market just pulled the rug out from under everyone. Billions wiped out in hours, confidence gone in minutes. And while most people are panicking, something very important is happening quietly in the background. That's the part nobody's talking about. Stay with me, because what's happening right now in China's precious metals market isn't noise. It's a signal, and if you understand it, you'll start seeing market stress very differently from here on out. If you're holding metals, watching metals, or trying to figure out what this volatility actually means, you're in the right place. Because what I'm about to show you is going to change how you read these sell-offs forever. Now, before I explain what's actually driving this, let me teach you something most people never really internalize about markets. Price doesn't always equal reality, especially in moments like this. Think of markets like an auction where half the bids are emotional, leveraged, and forced. When stress hits, the loudest sellers aren't the strongest hands. They're the weakest, the ones who have to sell. They don't choose their timing. Margin calls choose it for them. Redemptions choose it for them. Meanwhile, the quiet buyers don't announce themselves. They don't chase candles. They don't show up on Twitter. They wait. And they accumulate when liquidity cracks. That difference, forced selling versus strategic accumulation, is one of the most important patterns you can learn to recognize if you want to stay ahead instead of reacting late. When you see price action that looks like panic, you need to ask yourself one question. Who's selling because they want to, and who's selling because they have to? That question alone will filter out most of the noise. If this is making sense so far, drop a comment and let me know you're following along. So here's what's actually happening right now. While Western markets are dumping paper gold and silver contracts, China has been doing the opposite. Official data shows the Chinese central bank added gold to its reserves for 14 consecutive months through December 2025. 14 months. That's not a trade. That's a policy. And at the same time, inside China, physical silver demand hasn't collapsed the way futures prices suggest. In fact, local prices have stayed firm even as global spot prices retraced hard. Why? Because real demand didn't disappear just because traders hit sell buttons. Let me break down the sequence for you. First, global risk-off selling hits. Funds deleverage. Futures markets get slammed. That pushes headline prices down fast. Second, that paper selling creates the illusion that demand is gone. Charts look ugly. Headlines turn bearish. Sentiment flips. But then you look closer, and physical flows tell a different story. Retail demand inside China stays elevated. Industrial demand stays elevated. And starting January 1st, 2026, new export controls restrict how much silver leaves the country. So, supply tightens locally just as global prices weaken. Here's what's wild about that. When futures prices fall but physical premiums stay strong, that divergence doesn't last forever. It resolves. And historically, it resolves upward. Think about what that means mechanically. Futures are paper contracts. They settle in cash or can be rolled indefinitely. Physical is physical. You either have it or you don't. When paper markets get hit by forced selling, prices can drop on volume alone. No demand destruction required. But physical markets only fall when actual buyers walk away. And that hasn't happened. You've got buyers in China still willing to pay premiums over spot. You've got industrial users still consuming at elevated rates. And you've got a government that just restricted how much metal can leave the country. That's not the setup for sustained downside. That's the setup for a repricing. But here's the part that should make you nervous if you're only watching charts. Futures markets can fall on fear. Physical markets only fall when demand breaks. And demand hasn't broken. What you're seeing right now is a divergence between perception and reality. Perception says metals are weak because prices fell. Reality says the largest buyer in the world is still accumulating. Reality says physical tightness is increasing, not decreasing. Reality says the policy environment just shifted toward restricting supply. Now, I'm not saying prices can't fall further in the short term. Markets don't move in straight lines. But I am saying the mechanics underneath this sell-off don't support a fundamental breakdown. They support a shakeout. Now let me show you what very few people are talking about. This export control isn't some random policy. It's strategic. China produces more than half the world's silver. They're the largest refiner globally, and they just told the world they're keeping more of it inside their borders. At the same time, their central bank is stacking gold month after month. That's not coincidence. That's coordination. When you combine sustained official buying with tightening physical supply, you create upward pressure that paper markets can't suppress forever. The futures market can push prices down today. But if physical premiums keep rising, arbitrage forces start working. Traders buy cheap futures, take delivery, sell into physical markets at a premium. That mechanism pulls futures prices back up toward physical reality. It's not instant, but it's inevitable. And the wider that gap gets, the faster it snaps back. Now zoom out with me for a second, because this isn't new. This is the exact same playbook we've seen before. In the early 2000s, central banks quietly accumulated gold while prices went nowhere for years. Everyone thought gold was dead. Central banks were supposed to be net sellers forever. Then the data came out. They'd been buying the whole time. After the 2008 crisis, paper markets collapsed first. Gold and silver got hammered in the initial panic. But then physical shortages showed up. Premiums exploded, and prices followed the physical market, not the paper market. Even in 2020, during the initial COVID crash, metals sold off hard in March. Silver dropped from $18 to $12 in days. But physical premiums went to $4, $5, $6 over spot. You couldn't buy a coin anywhere near spot price. The market was telling you the paper price was wrong. And what happened next? Silver went from $12 to nearly $30 in less than 6 months. Every time this pattern appears, it looks confusing in the moment. Prices down, headlines bearish, sentiment negative, but the larger story is accumulation during chaos. And when you zoom out, you see that sustained official buying combined with physical tightness has never resolved lower over the long term. Never. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could China stop buying tomorrow? Sure. Could prices fall further in the short term? Absolutely. Could this export control be reversed or watered down? Maybe. Could Western demand collapse enough to offset Chinese accumulation? It's possible. Here's the thing. It doesn't actually matter whether China's motive is currency diversification, geopolitical hedging, or something else. The mechanics are what matter. You don't need to know the why to trade the what. You just need to watch flows, watch reserves, watch physical premiums, watch policy. Focus on what you can verify, not what sounds dramatic. That's how you stay grounded when everyone else is emotional. And honestly, manipulation claims don't help you make better decisions. You don't control what central banks do. You don't control futures markets. But you can control what signals you pay attention to and how you position accordingly. There are probably 3 types of people watching this right now. Maybe you're the trader, staring at short-term charts, frustrated by whipsaws. You bought thinking metals would bounce, and instead, you're down another 5%. If that's you, your job is risk management first, not prediction. Volatility kills impatience. It rewards position sizing and stops. You don't need to catch the exact bottom. You need to survive the chaos and still have capital when the trend resumes. Scale in, don't go all in. And if you're trading leverage, honestly, this kind of environment will eat you alive if you're not careful. Maybe you're the long-term holder, wondering if this drawdown means you were wrong. You've been stacking for months or years. You believe in the thesis. But watching your portfolio bleed hurts, and doubts creeping in. Let me say this clearly. Volatility doesn't invalidate a thesis. Structure does. And the structure hasn't changed. Central banks are still buying. Physical demand is still firm. Policy is still tightening supply. Nothing about this sell-off changes those fundamentals. What changed is sentiment. Sentiment recovers. Or maybe you're newer, trying to figure out how to even read signals like this without getting overwhelmed. You hear one analyst say it's going to the moon, another says it's going to zero, and you don't know who to trust. If that's you, start simple. Ask who's buying, who's selling, and who's forced. That question alone will filter out most noise. Ignore the predictions, watch the actions. No matter which category you're in, the universal principle is the same. Don't confuse price shock with demand destruction. One is temporary, the other is structural. So here's what I want you to answer in the comments. Are you watching this as a trader looking for entries? Are you holding long term and just riding it out? Or are you still trying to figure out your strategy? I'm genuinely curious where you're at because it helps me make better content for you. Here's where I stand. I'm not chasing panic and I'm not ignoring risk. I'm watching signals. First, I'm watching central bank disclosures, not headlines, actual reserve data. If China's buying slows or stops, that's a structural shift worth noting. But as long as they're adding every month, the accumulation story is intact. Second, I'm watching physical premiums versus futures prices. If that divergence keeps widening, it's telling you the futures market is disconnected from reality. When it narrows, you'll see it in price action. Third, I'm monitoring export policy and trade flow changes, because those are slow-moving but powerful forces. Policy doesn't reverse quickly, and once supply gets tight, it doesn't untighten overnight. The way I see it, this sell-off was mechanical, not fundamental. Futures got hit by forced selling, leverage got flushed, sentiment turned negative, but the fundamentals are still being quietly reinforced by the largest buyer in the world. Based on my analysis, if you're looking at this from a 3-month, 6-month, 12-month perspective, today's fear becomes tomorrow's repricing. Now I'm not a financial advisor. This is not financial advice. Do your own research. Make your own decisions. But I'll tell you what I'm doing. I'm watching for stabilization. I'm watching for physical premiums to hold or expand. And I'm watching for confirmation that China's policy remains consistent. If those three things line up, this drawdown isn't a breakdown. It's a setup. If history rhymes and physical markets stay tight while futures wash out weak hands, the move that follows could be significant. Not because of hype, because of mechanics. Because of the same pattern we've seen play out multiple times before. And if you made it this far, you're thinking critically. You're not just reacting to headlines. That mentality will serve you well. If this helped you see the situation more clearly, share it with someone who needs to hear it. Subscribe if you want more breakdowns like this. And stay sharp out there. Think critically, verify the data, and always make your own decisions. I'll see you in the next one.